Let's stop pretending that keeping your cash in a bank account is going to save you. We've all been conditioned to think if I just stack my cash in a saving account, I'm safe. I have peace of mind. But the reality is brutal. Inflation is quietly eating away your purchasing power while you sit in your hands and wait. What's up, guys? Tyler here. Today we're breaking down why hoarding cash under your mattress or leaving it in a standard bank account isn't a safety strategy. It's literally a guaranteed way to watch your wealth vanish. Sound harsh? Stick around, because I'm about to show you why this is a massive deal right after you smash that like button and subscribe. At first glance, inflation feels like a minor inconvenience, like who cares about 2 or 3% a year? But that is exactly where the trap snaps shut. Those tiny percentages silently compound into a massive black hole in your wallet. Because inflation doesn't hit you just once, it hits you every single year. And as it compounds, your money doesn't just lose its face value, it loses its ability to buy the exact same things you're used to buying. For example, back in 2022, inflation in the US spiked all the way to 9.1%, the biggest jump we've seen in decades. Imagine you had $10,000 cash sitting in an account. Just a year prior, that $10,000 could buy you a solid, reliable used car. Fast forward 12 months and suddenly you have to keep saying just to buy the exact same vehicle. This is exactly why inflation is called a hidden tax. A friend of mine from Latin America once told me something very simple. When inflation hits double digits, people stop debating whether it's real. They see it every single day at the grocery store. But even a small, seemingly normal inflation rate works the exact same way. It's just slower. Let me give you a couple of historical examples so you can see just how terrifying a force this really is. Back in the 90s, the average income in the US was significantly lower than it is today, roughly 3 times lower. And over the last few decades, wages, prices, housing, and everything, living expenses have skyrocketed. Now, imagine your parents were making an average salary of $20K a year back then, and they managed to save half of it. They didn't invest it, they just hoarded that cash for their future. In today's economy, with today's prices, that $10K they spent an entire year grinding to save wouldn't even cover half of your basic living expenses for a few months. And by the way, if you want a deep dive into the math of why this exact logic makes buying a house today nearly impossible compared to our parents' generation, go check out this video right here. Now, let's look at a different scenario. Let's pretend inflation doesn't exist at all. Instead, every year your bank just directly skims 5% of your account. You've had $10,000. Next year, it's $9,500. Now it's $9,000. You get the math. Sounds absurd, right? You'd switch banks immediately. But in the real world, the exact same thing is happening. Inflation doesn't physically take the dollars out of your account. It just shrinks the amount of stuff those dollars can actually buy. So the question isn't whether you have numbers on your screen. The question is, what is that money actually worth? And that's where most people realize for the first time, simply saving money does not mean preserving wealth. Now you might argue, but Tyler, I put my money in a high-yield CD, at least I'm earning interest, and government bonds are backed by the state. It sounds logical on paper, but financial history tells a completely different story. If you look past the nominal yield and focus on the real yield, meaning your returns after subtraction inflation, the picture gets incredibly grim. Right now, the average yield on a standard savings account at the traditional US bank barely scratches 0.38% a year, while inflation is still sticky. Even the best CD rates rarely outpace the real cost of living, leaving you with maybe a fraction of a percent in actual purchasing power gains. With US Treasuries, the situation is slightly better. For instance, 10-year Treasuries, Treasury Inflation Protection Securities, have historically hovered around a 2% real yield above inflation. Better, sure, but it's definitely not making anyone rich. In fact, Jeremy Siegel in his financial classic, Stocks for the Long Run, broke down the data over a 200-year horizon. $1 invested in short-term bonds yielded a real return of about 2.8% annually, while long-term bonds yielded around 3.6%. When you look at centuries of data, those numbers are tiny. Long story short, putting your money into safe havens is a method to merely tread water, not to build actual wealth. And what about gold? Oh, the ultimate safe haven veteran isn't a fairy tale either. Over the centuries, gold has barely beaten inflation. $1 worth of gold turned into roughly $4.06 after 220 years. That is virtually identical to just keeping your purchasing power flat. At the end of the day, all classic safe options either barely match inflation or actively lag behind it. So what's the move? First, make sure you're subscribed to my Telegram channel where I break down how to actually build a financial engine. Second, here's your ultimate weapon against inflation: investing in cash flowing, high-yielding assets. Let's say you've stacked your first $10,000. What's next? When I first asked myself that question, it turned out the options were incredibly limited, and every single one of them comes with a price tag. The paths look different. Take real estate, for example. Sounds perfect. You buy a property, rent it out, and collect maybe a 7 to 8% annual yield. But in reality, it's a grind. To get a real margin, you have to deploy tens of thousands of dollars upfront, deal with property management, maintenance, and tenants. It requires massive initial capital, carries high risk, and gives you a major headache. Another option is starting a business. Sure, sounds awesome, but think twice. A regular everyday investor can't just buy a fully optimized cash flowing business. Let's be real, not everyone has the skill to scale a company from scratch, and your initial returns will likely be zero, if not deeply in the red. The failure rate is massive, and that leaves you with stocks and funds. The historical average annual real return of US stock market over the last several decades is around 6.7% after inflation. And if you buy and hold for 40 years, compound interest while work wonders. But in the real world, markets are volatile and most people can't handle just sitting on their hands during a crash. While equities have historically crushed bonds, gold, and cash, I'm guessing you don't have a spare 200 years to wait around. So do you actually make your money work for you right now without needing millions upfront or waiting a lifetime? This is exactly where most people first discover the word trading. And this is exactly where most people make their first mistake. Because online trading is constantly sold as magic, get rich quick button. But the reality is completely different. High yields always come with a price. Is it possible to pull the returns of significantly beat markets average 6 to 7% a year? Absolutely. On good days, you can see way north of 10%. But this is where most people stop listening. Let me repeat. Everything has a price. Behind every extra percentage of return stands hours of chart analysis, hard data, strict risk management, iron discipline, and the psychological ability to take losses. The market does not pay you because you want to make money. It pays you for the quality of your decisions. And I realized that very quickly. Trading isn't a shortcut to instant wealth. It's a highly skilled profession. And the higher the potential payout, the higher the cost of a single mistake. That's why entering this market without edge, a systematic blueprint, and the right framework is incredibly dangerous. Most beginners don't lose money because the market is rigged against them. They lose because they come looking for easy money, and instead they hit a wall of hard work. But when you have a structured system, discipline, and proper education, risk becomes completely manageable. On the flip side, passively hoarding cash in an inflationary environment, this is also a massive risk. It's just hidden, quiet, and highly convenient for those people who choose not to notice it. And at the end of the day, everyone decides how to handle their capital. But is it really worth letting your money sit dead? Wouldn't you rather turn it into a tool that actively works for you? And if you want a deeper, no BS understanding of how the markets, investing, and trading actually work, head over and join my Telegram channel. That's where I share my live trades, market insights, break down mistakes, and show you exactly how I execute my edge in real time. No hype, no fake promises of easy money, just raw execution and the exact strategies I use myself. The link is down in the description. I appreciate you guys watching and have a profitable day.